Realtors Association's annual year-end housing market update. I am Todd Urbanski, 2019 President of the Minneapolis Area Realtors.
And I'm Patty Jo Fitzpatrick, 2019 President of the St. Paul Area Association of Realtors. The story of the Twin Cities housing market in 2018 was one of maturing recovery, and we are looking forward to sharing some positive news as well as a few challenges.
As most of you know, a shortage of housing supply has caused an increase in home prices that's brought about some affordability challenges in certain areas. We are here in North Minneapolis and at Thor Company's new headquarters for a few reasons. First, this community is fortunate enough to have affordable home ownership opportunities, close to major job centers and regional attractions. Second, comprehensive redevelopment efforts like this Regional Acceleration Center can transform communities. Housing and economic revitalization go hand in hand. Third, this particular project represents an important convergence of public, private, and nonprofit organizations partnering to help this incredible community thrive. Prior to my getting involved with real estate, I was actually was a plumber for several years. Our shop was right over off of Broadway in Irvine. I believe it's still over there, but this was kind of our home turf here. We did a ton of work in this community. I've been inside a lot of the homes here, and the homes are so unique. Beautiful built-in buffets. The woodwork is immaculate in a lot of the homes. It's just a great community here. It's great to see things like this. The investment that the city of Minneapolis is making with a brand new fire station over off of Broadway. Devin George's programs that he's running here in North Minneapolis. It's exciting to see some good things happening in this community.
We are in the heart of a flourishing metro area surrounded by growing businesses, great jobs, a vibrant food and entertainment scene, reliable infrastructure, and a variety of housing opportunities. All these things are more and more make the Twin Cities one of the best places to live. We are an incredibly high-performing region by almost any measure. However, we also have one of the biggest disparities. This very project, this building, was building on the work of others, aims to address that. This is the largest North Side development in 50 years.
We're thrilled you're able to join us this morning to discuss the past year in housing and what might lie ahead. Let's get started. Most housing indicators point to a ripening recovery in the 16-county metro area. Seller activity was nearly flat, down just 0.3% compared to 2017, but we're thirsty for more listings. Buyers, while still motivated by rising rents, good jobs, wage growth, and low rates, closed on 3.4% fewer homes. But 2018 still had the fourth highest sales count since 2003. That dynamic finally set the stage for our first inventory gain since 2014. The number of homes for sale rose 4.5% versus the end of 2017. That's an extremely important development.
That's right. And days on the market set a new record with a median of 22 days and an average of 48 days. That means half the sales in 2018 took less than 22 days to go under contract. That record pace, combined with persistent supply-demand imbalance, push our median sale price up 7.7% to $265,000. That marks an important milestone. It's the highest median home price ever recorded in the Twin Cities. Our previous high was $230,000 in 2006. Also, sales of homes are at or above the $1 million mark threshold reached an all-time high as well.
And that's not the only new record in 2018. The percentage of original list price received actually exceeded 100% for a few months last year. Overall, half of all homes sold for more than the original list price, the highest share on record going all the way back to 2003. That said, by the end of last year, there was some evidence this trend was beginning to change.
One area of concern for consumers is housing affordability. Our income in our region, affordability index ended the year around 150. That means the median income in our region is 150% of, or 50% greater than, the minimum qualifying income needed to purchase the median-priced home under the prevailing mortgage rates. That assumes 20% down and a maximum of 30% of pre-tax income spent on housing.
Right. For comparison, that affordability index was about 125 in 2005 and 2006, but rose all the way to 280 in 2012 when interest rates and prices reached their valley. In other words, the affordability index is still above 2006 territory, our high mark. Rising incomes, more moderate price growth, more supply, and incremental rate changes will all help preserve our affordability compared to other regions. However, the most telling fact is that a mortgage payment on a median-priced home today is less than what it was in 2006. We have low interest rates to thank for that, but we're still seeing prices rising faster than incomes, which can obviously be problematic.
Another area of concern is new construction activity. This embodies many forms: urban condos, suburban townhomes, and single-family subdivisions on the outskirts. Whatever your preference or life stage, whether growing a family or downsizing an empty nest, there are 4 specific hurdles complicating residential new construction.
We like to cite the 4 L's: lots, labor, lending, and lumber. Lot and labor supply is extremely tight, and that of course drives up costs that are conveyed to home buyers. Construction loans, the 3rd L, are still a challenge, forcing some developers to get creative with financing arrangements. And then of course the tariffs on Canadian lumber, the 4th L, are driving up the cost of framing materials, especially with 2x6 studs. Increased regulatory hurdles can also drive up the cost of housing production. The Builders Association of the Twin Cities and Housing First is a great resource for this kind of information.
The interesting thing is, the last time buyer activity was this high, about 15% of our MLS sales were new construction. In 2018, only 9% of our listings are new construction. The bulk of the builder activity has shifted towards single-family suburban developments, oftentimes skewing towards the higher end. It is difficult to be profitable building homes under $300,000, despite the robust demand at that price point. That, combined with the risk of litigation, means developers are building condo-quality apartments now, perhaps to convert later.
Bottom line, we need more housing supply across the spectrum, but particularly at the entry-level prices. The health of our economy and labor market is a major driver of new household formations, which is a leading indicator of housing demand. At just 2%, the Twin Cities has the #1 lowest unemployment rate of any major metro area with a population over 1 million people. But our strengths do not stop there. We consistently rank at or near the top of any region for health, employment, income, home ownership, education, volunteering, voter turnout, bicycling, and overall livability.
Spoken like a proud Minnesotan. Speaking of political engagement, there are several important policy developments in 2018. Housing was a priority in many parts of the metro as cities pursued new policies to ensure more housing options in their communities. For example, St. Paul followed Minneapolis by allowing accessory dwelling units citywide. Minneapolis passed the 2040 plan, which garnered national headlines for far-reaching zoning deregulation and encouraging more density. Affordable housing was a focus on both sides of the river, with an affordable housing tax incentive program and a new housing trust fund. There's plenty of work to do to create more housing and inventory, address affordability gaps, and ensure that all Minnesotans have access to safe and quality housing.
Now let us briefly look ahead to what 2019 might bring for the Twin Cities housing market. It is important to preface this by reminding everyone that there's a high degree of uncertainty when it comes to predicting the future. That said, here's how we expect 2019 could look, barring any unforeseen events, of course. Number one, we feel that our for sale inventory is going to increase by 5 to 7% through the course of the year here. Our home prices, where we're going to see somewhere right around 7.5% in 2018, will probably come down a little bit to a 5 to 7% increase in 2019. New construction sales, we're starting to see, if you're reading the press at all and watching what's going on, especially on the outskirts of our metros, a lot of dirt's being turned over. Roads are being cut in. Projects are getting, communities are getting excited over new housing projects. Where I live in Chaska right now, we're seeing tons of dirt work being done. And so we expect our total new construction sales to be up about 10 to 15% in 2019. And then if we look at our GDP growth, we're going to be up moderately, about 2.3%. The crystal ball always gets a little bit cloudy. So some of the things, caveats or uncertainties that we see coming into 2019 here. There's lots of talks about the stock market, trade wars, politics, corporate earnings, weakened global growth, and Brexit could all affect what happens in 2019.
Overall, we expect the buyers will remain active this year, but we may not surpass recent sale numbers. The big question is whether sellers and builders add significant inventory, and then whether buyers are willing and able to purchase it. The economy should continue to produce jobs needed to support the housing market and home ownership. The underlying fundamentals remain conducive to a well-functioning and sustainable housing market accessible to all.
Thank you all for taking the time to be here today, and we are happy to take any questions that you would have.
Any concerns about, I know we had before we had the crash in home prices in 2005 or so, in the early 2000s, of this bubble, concern about a bubble. Any concerns about that right now? Sure.
So if you mind?
Yeah, go ahead.
If you look back to 2005, 2006, when we had the bubble, the start of a bubble, if we looked at our overall inventory at that time, we were anywhere from 35 to 40,000 homes on the market on any given week. Right about now, we're at about 12,000, and we're higher than what we were a year ago. And so when you really look at what causes a bubble, it's supply and demand. We had a huge supply and not much demand in 2005, 2006. Right now, we have higher demand and less supply. Beyond that, the lending standards have changed dramatically. There used to be a program called Ninja Loans. No income, no job, no assets, sign here. Those programs have gone away. So as far as the bubble goes, I don't think, we're not going to see that.
Sure. Yeah. Also, speaking of the crystal ball, I'm wondering if we may see an impact from, if the federal government shutdown continues any longer, that we might see an impact from lending that relies on federal government to approve loans. Do we see any possible issues with that?
Well, I would defer that off to our government affairs person, Eric, or Madeline, to discuss. But I think that really right now, it hasn't impacted us at this point. I think the rural development is where we're seeing a little bump in the road there. But other than that, it's, so far smooth sailing. Eric and Madeline, any comments?
Yeah, in the first 5 days of the actual shutdown, there was concern that there wouldn't be secondary financing available for underwriting of new loans. And NAR worked quickly behind the scenes with the administration and with those players in the secondary financing market. And so since day 5 or day 6, even until today, sitting here at day 32, we haven't had that problems at all. The president mentioned it, but I mentioned it. The one program that has been impacted more than others has been the Rural Development Loan Program, and that's just a function of the federal government, who's considered essential employees, and they're not. And so they're not in right now, so that program hasn't been funded. But that ends up being a significantly smaller share of the overall secondary mortgage market.
Sure. You might expect like a backlog of once these employees get back to work, once the shutdown.
They may have internally for that one loan program, yes, but overall, we're not seeing a major system impact.
Okay, thanks.
Fur-
Any other ones?
Further questions? Anyone?
Okay, thank you.
Thank you.
Thanks.